Chart pattern example case study 99 YUM. Price action is neatly contained within an inclined double bottom. It marks the lower boundary of the gap up range as a firm foundation for a likely return back to previous highs. The 77 range was also a significant range prior to the gap up, as shown by the swing points before November. Similar to other examples, a long-term uptrend resumes on a more aggressive phase to new highs after a gap up is not immediately filled. When new highs are established, the old mid to upper 80s range becomes the primary concentration of support after a relatively compact double top range fails. The price action into 2019 is highly volatile, but a stable bullish presence emerges as a gradual incline produces consecutively higher upswings. The gap up range marks another case of a triple top originating from a failed ascending triangle. Price action is neatly contained within the main outline, but the lower boundary of the triple top is extended due to the 112 to 114 range also being the approximate gap fill area. A morning star in mid-December delays the likely downtrend as major volatility slowly begins to decrease. In the short term, the transition into October was highly uncertain, but in the broader context, it was merely a resting phase range to accelerate the downtrend. A bearish continuation with classic 3 methods falling price action. This is even accelerated by a gap down. Interestingly, this gap down range is defined by a large bull hammer that halts the downtrend. Similar to marking an IPO candle, the open, high, low, and close prices of the large bull hammer are all marked. They neatly define a wider gap down range. Even before the descending trend line is crossed, there is a noticeable incline prior to the current breakout. This is more easily identified as a channel by mid-January, when there is stronger resistance potential producing a small downswing near the intersection of the trend lines and the 102.49 gap down open. The formation of the current uptrend can be traced to a triple bottom that has progressively flatter upswings before the channel. 103.60 is quite precise, as the January 17th candle gaps up and almost opens directly on it, as does the crucial bull hammer on January 25th. As the broader market begins to sell off by late February, the upward channel breaks for a classic bearish continuation. This immediately neutralized the otherwise stable uptrend in development. The gap down just barely misses being filled due to the growing bearish acceleration. Similar to other charts, YUM would have likely continued the earlier upward channel if it were not for the bearish period in the broader market in early 2020. This is shown by a relatively quick and stable recovery. As a triple top completes and is followed by neutral to bearish price action, the chart provides another reminder of patterns only being approximations of more favorable conditions for certain price movement, rather than guarantees of strong reversals and continuations.